Fidelity, the big player in asset management, is looking to bring one of its investment funds into the blockchain world. The company has filed with the SEC to launch a new on-chain share class for its Fidelity Treasury Digital Fund, which is almost entirely invested in U.S. Treasury bills. So what's the big deal? This new share class will use Ethereum ETH to record transactions, making ownership more transparent. While the official records will still be kept by Fidelity's transfer agent, all transactions will also be tracked on the blockchain. That means more visibility and, potentially, fewer headaches when it comes to tracking who owns what. According to the filing, the blockchain records won't be the official proof of ownership, so don't lose sleep over that. But they'll be checked and reconciled daily with Fidelity's main records. And while Ethereum is the first choice, Fidelity is open to using other blockchains in the future. A step toward a more transparent, blockchain-powered financial system? Maybe. But either way, it looks like even traditional investment firms are warming up to crypto tech. Best-selling author Robert Kiyosaki believes Bitcoin, BTC, is one of the biggest wealth-building opportunities in history. Speaking to his 2.7 million followers on X, the Rich Dad Poor Dad author says there are two types of investors: those who jump in because they don't want to miss out, those who hesitate out of fear of making mistakes. According to Kiyosaki, history favors those who believe in Bitcoin. Most of us have heard of FOMO, fear of missing out. But the real reason many people stay poor is FOMM, fear of making mistakes. Bitcoin has made it easy for everyone to get rich, yet those with FOMM will miss out on one of the greatest wealth opportunities ever. He predicts that as Bitcoin rises, more people will rush in, creating what he calls generational wealth. But those who wait too long will end up saying Bitcoin is too expensive when it passes $200,000. Kiyosaki is so confident in BTC that he's been selling his gold and silver to buy more Bitcoin. Back in January, he even predicted BTC could hit $250,000 by 2025. At the time of writing, Bitcoin is trading at $87,507. So, will you embrace the opportunity or watch from the sidelines? Billionaire investor Chamath Palihapitiya believes stablecoins are helping cement the US dollar as the world's dominant currency. In a new post on Substack, Palihapitiya points to Federal Reserve data showing the dollar has hit its highest value in 40 years. He says a mix of economic factors, like rising interest rates and growing demand for dollar-backed stablecoins like USDT and USDC, is keeping the dollar stronger than ever. The Federal Reserve's interest rate hikes, from near zero to over 4%, have pulled in global investors looking for better returns. Meanwhile, geopolitical tensions have made the dollar a, quote, safe haven currency. And now, stablecoins are fueling, quote, digital dollarization, further increasing global demand for USD, even in crypto markets. But there's a catch. Palihapitiya warns that a strong dollar isn't always good news. While it gives Americans more purchasing power abroad, it also makes US products more expensive globally, which can hurt American businesses. Worse, a soaring dollar can trigger financial crises in other countries, adding more pressure on the Fed to balance inflation and global stability. So, is the dollar's dominance unstoppable? For now, it looks like stablecoins are giving it an extra boost. Economist Alex Kruger says former President Donald Trump's upcoming tariff plan could be a game-changer for the markets, including crypto. Trump has declared April 2nd as Liberation Day in America, the day he plans to hit countries with new tariffs. But so far, the details have been murky, with mixed signals from his administration on how aggressive the tariffs will be. Kruger told his 208,500 followers on X that this could be the biggest market-moving event of the year, even more impactful than any Federal Reserve decision. What could happen? If Trump takes a softer approach, markets could rally hard and fast. If he's vague about the details, uncertainty could cause wild swings in both directions. If he goes all in, markets could plunge 10 to 15% in no time. Kruger also warns that if markets tank, Trump might walk back some tariffs in the following weeks, aiming for a better negotiating position. That could mean peak market negativity by mid-April, right around U.S. tax day. While the U.S. economy remains strong for now, tariffs could slow things down. But since economists are already expecting a sharp slowdown by year-end, some of the damage might already be priced in. Bottom line? Buckle up, April 2nd could be a wild ride.